Smithson PLC on 1st April 2018 for 150,000. So just to even understand that statement, we should know that Smithson is a subsidiary. Why do we say that? 75% control automatically sits in the category of a subsidiary. Then they've said on the 1st of January 2018, Jameson and 4 friends jointly set up Weston. Who's Weston? It's a joint venture. You heard how they stated it, jointly. That's a sign to tell you that there's a joint venture called Weston Limited. They've even told you the amount they bought. Weston. That's 250,000. The next thing is that told us the financial statements as follows. This is the statement of financial position. So let's get straight into the workings and just quickly understand this question. So the first adjustment, if you can see there, it's saying Jameson sold to Smithson for 40,000. Jameson earned a markup of 20% on these sales. So of 20% on these sales. There's a full stop there. Then it says 25% of these goods were resold as at year end. Okay, let's just end there for now. So let's take note what's happening. Jameson sold to Smithson. It's like a parent selling to a subsidiary. How do you treat such? There's unrealized profit actually here because there's a markup and something talked about. So there's that unrealized profit that's seated in the books of the group, and intra-group transactions should be cancelled. Remember that according to IFRS 3, it says that you should eliminate intra-group transactions. So anyway, getting back to this, remember this is a sales figure of 40,000, but you have been given a markup. So whenever you've been given markup against sales, it can't work. You have to convert to margin. Margin is 20. Margin is going to be now 20 over 120. Why have I said that? Let me just quickly show you on the screen. So if you pay particular attention to the left hand side of the screen, you will see how I've converted from markup to margin. Take note that the first fraction is 20 over 100, meaning that's just 20% expressed as a fraction. That's just markup still. Now, how do you convert? The denominator is what really changes. You add a 20 there and then it becomes 20 over 120. Then you use that same fraction to now multiply what? To multiply on the given sales, which is, if you're still looking at the left hand side of the screen, the small window that I've opened, we have 40,000 were the sales, and now you're using 20 over 120 to see how much profit is seated. It should give you 5,000, sorry, not 5,000. You're going to get, let me just recalculate that quickly. So if you look at the left hand side of the screen yet again, I've managed to calculate the profit. It's supposed to be 6,666.66. It's a recurring fraction, but that's the actual unrealized profit. Then they tell you that 25% have been resold according to what the adjustment said. So we're interested in what they are still keeping, because what you're still keeping is the unrealized profit, which you're somehow recognizing, and we want to eliminate that. But if you've resold elsewhere, there's no problem. We don't even consider that. So you're just interested in what is still with you, which is the 75%, which they haven't even said. They've just said 25 has been sold. So automatically, you know that 75 is what's left with you. So that's how you charge 75% of that 6,666. And then that gives you 5,000 flat as your unrealized profit that's seated in the books of this person that sold, the parent, because it's the parent to subsidiary, if you remember what we said. So then that's one. What do you take it? It will go to working 5, group retained earnings. Why? The parent is the one who's recognized the profits. And which adjustment treats the parent? Mostly, it's mainly actually, it's working 5. So that's what we'll go and subtract the 5,000 from. That's it for adjustment 1 for now. Then we'll look at the other one, which is about, but let's just analyze it anyway, the ending part of adjustment 1 and 2. It's ending and saying that Smithson still owes Jameson 20,000 in relation to these sales. However, Jameson claims that the subsidiary still owes over 25,000. This is equally an intra-group transaction. So this is equally an intra-group transaction. Why we're saying that is that, again, someone is holding a receivable, someone has a payable among someone in the group. That's not allowed as well if you're part of the same group. So what you're supposed to do is recognize what's happening. Someone is saying there's a 20,000 in their books. Who is it? Smith still owes Jameson 20,000. So Smith thinks that in Smith's books, there's a payable of 20,000 that they need to pay. That's why we're even calling it a payable. And then this side, Jameson is claiming that him in the books is 25. There's actually a difference. That difference, what we now will call that difference, it will be what we would say cash in transit. Yeah, it can be actually cash in transit because there's some amount they are missing of 5,000 if you're able to notice. So that's why maybe someone is thinking that, I may actually still think there's 25. You'll see what's going on there. So basically, what we're supposed to do is in Smithson, okay, we have to cancel out the 20,000 payable. It's not supposed to be recognized as a payable. That's in the first place because it's an intra-group transaction. So we'll have to go and reduce our payables by 20. Next, this guy Jameson, he's saying he's expecting to receive because, as you said, Smithson is supposed to pay. So this guy here, Jameson, is the receiver. Yeah. So 25 receivable also has to be what, written off. It's equally an intra-group transaction. So you cancel off the 20 at the payables, cancel out also a 25 from the receivables. But how do you account for the 5,000 difference? This is the crucial part now. We've just said we'll account for that as a cash in transit. And what do you do to a cash in transit? You just add it to cash and automatically the transaction cancels itself and everything is gone. Let's go to adjustment 2. On July 2018, Smithson transferred an item of property, plant and equipment to Jameson for 60,000. The item had a carrying amount of 50,000 kwacha and the remaining useful life of 5 years. This is a transfer of property, plant and equipment. Yeah. How do you handle this? Equally, this one, when you're dealing with it, you just need to look out for two things: extra depreciation and any unrealized profits on sale of plant. So look at the amounts. It had a carrying amount of 50, sold for 60. There's a difference of 10,000. That is your unrealized profit. That's the first thing to recognize here. Next, pick out the extra depreciation by simply getting that same difference. The difference is 10, right? Which we picked as a profit. You can just actually use that same difference and divide it by the number of years, the useful life. That will give you 2,000. Then that's the extra dip. It's the easiest way to get extra dip, and like you calculate dip on the 50,000, you calculate dip on the 60,000, then you subtract. That's a long cut, but you're better off like that. Then now, take note, when did they buy? The dates are very important in financial reporting. Very, very important. When did they transact? 1st of July. When is the year end? Very important as well. Check on top. They are preparing as of year ended 31st December. That already should ring a bell. That's 6 months left. So this person who has bought this asset has got that extra depreciation for 6 months, and that is what we're only going to account for. Okay, it's not the whole year that this person has actually had this asset. No, since the day he's bought here on the 1st July, it's just 6 months that you recognize the extra dip, and that's what we have to do to our 2,000 that we found by subjecting to 6 months over 12, leaving us with 1,000, and that's it. It's that easy. So remember, what do we take the 1,000? So it's simple. Also, first of all, who has recognized the profit? Take note that Smithson transferred. Whoever is selling always recognizes the profit. So Smithson's books had a profit of 10,000. This same one we calculated earlier on. So that profit is supposed to also be eliminated. We said intra-group, cancel. We have to cancel out. So you have to go and remove it. Now Smithson is a subsidiary. What do you adjust things for a subsidiary? It's working number 2. So that's why we take the 10,000 subtraction. Go to the next point where you take this. The 1,000 extra dip. What do you also record it? The extra dip is now being recognized by the parent, the one who's bought the thing now. The parent, remember, when you adjust for the parent, it's working number 5. Retained earnings, group retained earnings. So that's why we were supposed to take it. But remember, you are supposed to add it. So why are we adding? Under normal circumstances, depreciation is subtracted. Isn't that right? So when you're canceling something that was initially being subtracted, then you just have to do the opposite. Add. That's the reason behind. And it's that simple. Then you've treated this. The next thing is Jameson's group values NCI on a proportionate basis and joint venture are accounted for using the benchmark method. Okay, so the reason they've just talked about benchmark method is that when you're dealing with a joint venture, it can either be two methods, equity or benchmark. Benchmark is like proportional basis, where you're just taking a portion of what you control in that joint venture as you'll be adding to your assets, your expenses, and your other items. Yeah, so this other point as well that you just said, James Group NCI is on a proportional basis. What do they mean? You'll be charging to find the value for NCI. You need to get the portion of NCI and basically go and multiply it on the net assets at acquisition dates. That's what they mean by proportional. Okay, the next thing, we'll see all this anyway when we start doing now those 5 major workings. Here we're just analyzing all the adjustments. The fourth one is saying the 25% debenture in the books of Smithson represents monies owed to Jameson. What does that mean? So this is like an investment still in the in the subsidiary. You don't account for it. It's supposed to cancel out. Basically, it's supposed to be list out from the investment total given in the balance sheet. I think it's there. If you're, in fact, when you check on top here, we reached investment in subsidiaries, you've seen that there's a 50,000 talked about right now, that it's from the debenture. So the debenture equal is also in the financials. You check the debenture under the line of Smithson, there's a 50,000 seated. That's the one they're telling us that no, that one is part of investment in subsidiary, so should be eliminated together. They should all go. Yeah. So, because the investment subsidiary, remember, it started with a 150,000 on the top, the earlier statement when we introduced the question. So it's 150 plus the 50, and you can see why there is a total of 200 investment in subsidiary. It's adding up. Yeah, that's what those are actually meaning. The next adjustment is we have another adjustment. They're saying Jameson POC did not earn any profits between 1st January and the 1st March 2018. Okay, so that's just telling us that okay, they did not earn any previous in any, should I say, at acquisition date, there was nothing, like no profits between that period from 1st January when they started operations to 31st when they were even now acquiring a subsidiary and the like. Just a statement there. An item of property, plant and equipment of Weston Limited has been impaired by 40,000. They've just told us who's Weston first. Remember how we analyzed Weston is a joint venture company whom this company has also got some shares. This one, Jameson, has got some shares in there. Yeah, so the thing is that we'll come and account for his 40,000. Remember, in the group, they said Jameson and 4 others. So you have to make a fraction of 1 to 5, 1 over 5, because there are 5 people in total in the joint venture. Yeah, so basically, like I was saying, there are 5 people. They said Jameson and 4 other friends, meaning there are 5 in total who are part of this joint venture. They've invested all of them. So when you're trying to apportion them, you have to be fair. That's what I'm saying. 1 over 5. That's the fraction you're using for each and every individual in the joint venture to see the apportion that they'll be getting. And this is very important because if you're using benchmark method, which is also called proportional, that's the fraction you'll be using on everything that they own in the joint venture. You just say, oh, 1 over 5 of the total assets you put. Just like that. The next thing is okay, so even impairment, we're also going to do the same thing. You can't account for all the impairments. Yeah. So basically, when we're accounting for these impairments, the thing is that we'll have to just get that 1 over 5 of the impairment total. Why we can't account for the entire impairment? Because we don't have the full share in the joint venture. We're sharing it with other friends. That's why we're doing that. And okay, you will see on the workings that there will be a special treatment for all these things, because under normal circumstances, why do we take impairment? Yeah, so you don't really own the entire thing, and they will treat the workings. Impairment is usually taken to retained earnings. That's the rule. It's supposed to subtract it from your retained earnings. Yeah, and most of the time we'd also treat it in the, is it goodwill and whatnot. Yeah, but mainly this impairment that's coming from the joint venture, you just take it to group retained earnings, and also a separate working for the joint venture themselves as well. So we'll show that when we reach there. 7 is saying Jameson Limited acquired 40% of the shares of Blackstone Limited during the year for 75,000. Who's Blackstone? They've just brought in someone else. Remember what I was saying in the initial part of the question? We are solving a question on joint ventures, subsidiary, and associates in one. And this is now proving itself in the last adjustment. So who's this person, Blackstone, who's come in play? Already we've identified that we have a subsidiary, we have a joint venture. Of course, I know everyone would say automatically this is an associate, but let's just prove 40% of the shares automatically. Again, this is an associate. Why do we say that? An associate falls in the brackets of 20% to 50. So if you're within that range, you're an associate. How do we account for an associate? They say use equity method, which is a calculation of the cost investment in associates. That's what we would call the work. It's even a separate working, and we'll show that. So they've told you first of all the cost. They've acquired them for 75,000. It's very important that you'll be calculating your investment in associates, this figure. Then they're saying during the year, Jameson sold goods to Blackstone for 30,000 kwacha and earned a margin of 35% on these sales. So it's a margin, no need to convert. Margin is always charged on sales, so you just go direct and get the figure of the profits. Then they're saying 75% of these goods were still in Blackstone's books at the year end. how much? 75 are still in the book. So if you are still keeping things under a intra, as long as you're an associate, you're a what? It's still intra-group. You have become part and parcel. You're one and the same companies at some point. You've got some shares. So as long as there's that intra-group transaction, you have to cancel out whatever is seated. So of course, first you'll get your unrealized profit, which we can easily just calculate right now, so we are not lost. 35% of 30,000 is 10.5. But they've told you that 75% are still in stock. So we're even interested in what you still have, because you're not supposed to keep. Okay, if you're keeping in stock, then you're still recognizing that unrealized profit between the group. So that's why we want to cancel that same 75. That's going to give you 7,875. This is the figure. That's the figure that is the unrealized profit seated in your books. 7,875 kwacha. Now, when you're treating an associate, quite right, this is enough. You would say, okay, let's go and treat the same unrealized profit. But an associate has got an extra row. Remember, the way you treat a subsidiary, just what we've reached on the 7,875, that's enough. That's the unrealized profit. You even go and treat it in maybe the working 2 or working 5. Now, an associate, you go an extra mile and go to the percentage of control that you have in the associate, which is just 40%, and that's how much you're going to cancel out, because that's the only portion you control. So an associate is very different from a subsidiary. A subsidiary, the moment you just cross over 50, you have full control of everything. That's why we just had the entire assets of a subsidiary. We don't even apportion. Now, in an associate, their rules are a bit different. Of course, we've gotten the unrealized profit seated within the group, but it goes an extra mile to say how much do you really control in this associate, because 40% is not like total control. It's just significant influence. That's what the standard says in IS 28. Yeah, so in that case, you just get 40%, giving you how much? 3,150. And that's how much you're going to eliminate in the books. So this is the transaction between Blackson sold goods to Jameson. So Jameson has to go and write off this unrealized profits. That's working 5. As we said, Jameson's the parent. Parents adjustments most of the time are in the working 5. You have to go and remove this 3,150. Then you've accounted for this transaction. Yeah. So mainly that's that. And also this 3,150 is not ending here. Even when you're calculating this same investment in associate, they say unrealized profits should also be less in that calculation as well. So we'll see all this. What I just wanted us to find out is this figure, the unrealized profit from the sale transaction between an associate. Yeah. Then the statement is ending that the investment in Blackstone is said to have been impaired by 20% by year. And what do they mean? It's just simply telling us that when we're calculating the investment in this same Blackstone, who's the associate, we have to remember to remove impairment loss, and we'll account for all that. And the impairment loss will not only be removed in that calculation of investment in associates, it also goes in another place, working 5, the group, because once you're part and parcel of a stern group, you'll be adjusting on mostly 2 places. Yeah, so at least that double entry is being checking out. Yeah, so basically that's that. And we can go to now the working standards according to how now you consolidate. How do you consolidate now with those? Is it normally 5 workings? Yeah, but let's see, this time around we might have more, because we have got a joint venture, we have an associate, so we have to do all that. So as usual, you need the group structure: parent, subsidiary, non-controlling interests. So remember, these guys, they said they control 75% of this subsidiary, right? And 25% obviously is non-controlling. But when you have an associate, we even branch the structure further like this. We even say associate. So let me write it like this. Sorry for that. Let me just put it here. So A here. Then you put 40% to represent the associate control. That's how you write a structure, a group structure with transactions of an associate, subsidiary, joint venture. Joint venture, you don't show it here, like on part of the group structure. Just associates comes here. Next, working number 2. This is what we have now, the net assets. Now remember, usually usually under normal circumstances, if it's just a subsidiary, it will be net assets of the subsidiary. But in a scenario where you have associates, joint ventures, you also have to have their net assets respectively. So I'm just starting with the subsidiary right now. Subsidiary, I'll just put sub. Then what do we have usually under this heading? Acquisition, reporting dates. When we begin a share capital, what's the share capital? These ones I'll just give you the figures, and like going back to the question, we had 250,000 in this subsidiary, because you're picking from the subsidiary. Remember, you're picking from the subsidiary. We had 250,000, and another 250 this side, because share capital doesn't change both at acquisition and reporting date. Then retained earnings under this subsidiary, we were not given the retained earnings at acquisition date. Usually the questions would say in the intro, in the adjustments, but they didn't say. And if they don't say, the figure that you're seeing at reporting date under the subsidiary will be both sides on acquisition and reporting. So there's a 70,000 actually, and I'll put 70 both sides. As I said, if they don't tell you the retained earnings at acquisition date, then it's both. What's at reporting date will also sit on acquisition. Then remember that one we talked about, the unrealized profits from sale of plants. That plant property, land and equipment, where they made the 10,000 profits. That's why now you also bring it here, because we said who has the profits. It's the subsidiary who was recognizing the profit from that sale, and that's why we're adjusting it in working too. And basically that's it from our equation. That's what's coming here. The unrealized profit from the sale of goods, the other one repeating, that was in the first adjustment. If you rewind a bit in this video, the 5,000, it's only going to work in 5. Why? The one who's recognizing that profit was the parent, not the subsidiary. That's why we're not putting it here. Then you just close your workings. This will give you sorry for that, it's supposed to give you 270. Sorry, I think I've written this wrongly. The share capital, sorry, it's supposed to be 200. I don't know how I wrote that wrongly. Sorry for that. So it's 200. Initially the share capital is in the subsidiary. Then now we're now trying to put in the totals. 270 here. Here it's 260. The share of PAP is negative. Post acquisition profit is negative 10. Yeah, that's your PAP. Okay, I'm just removing the last zeros. It's supposed to be 10,000. Yeah, I just removed the last 3 zeros. Then, like I was saying, you also have to start another one. Net assets of associates. Just like that. Now, remember the associates, according to our question, they did not give us a column for associates. They just gave us a column for Jameson, a column for Smithson, and a column for Weston. Meaning, why didn't they give us a column for Blackstone, who is now called an associate? So as long as there's no, they do not give you those details, then you cannot calculate net assets, because net assets needs you to get share capital, retained earnings, and whatnot. So in that case, you won't have net assets for the associates. You won't have. It's just in this case. Otherwise, they are there. You can actually have, and if you make a working, I'm just showing it to you if the question had. So in that case, we'll just work the next one. Net assets of joint venture. Why? At least this one they disclosed. Weston is a joint venture. So I'll just put joint V. Acquisition dates, reporting. Then you just put the same thing. Share capital. So share capital under this based on the joint venture was now 250. That one was where I wrote wrongly. So it's 250. That's what was under the line of Weston. Share capital, you find 250 there. And retained earnings, same story. They didn't tell us at acquisition date. So it was what? So you just get the one at reporting, 220. You find that this one gives you a total of 270, and 270. That's it. Meaning the post-acquisition profit here is 0. You move. Working number 3, goodwill. Goodwill, how do we calculate goodwill? So goodwill mainly is calculated both, even for the subsidiaries, joint venture, associate, all of them. So like I was saying, the workings are the same, just that when you have got 3 things, you'll be basically doing 3. If it's one, the way it is, like the second working, you usually would do it for a subsidiary, but you have an associate, you also do the same thing for the associate. That's basically what's happening here. So here, this working is for goodwill. Goodwill we would do for the subsidiary. Now we also have an associate, we have a joint venture, so you also have to calculate for them separately. It's the same concept, just that you're doing them respectively. So we start with the subsidiaries, goodwill. Of course, we need the purchase consideration. We were told 150,000. Smithson is a subsidiary, by the way, and that's what they told us. Then they're saying use what? They want you to just hear proportional basis on NCI, meaning even goodwill calculation will follow the same. Most of the time, it also follows the same manner. But anyway, what we need in goodwill is the purchase consideration. How much did you acquire this subsidiary? 150,000. Then now, what's the next working here? We're supposed to less net assets at acquisition. But remember, you're only lessing that control, which is 75%. Yes, 75% of net assets. So the net assets of the subsidiary were how much? 270,000. So when you go charge 75% of that is giving you 2025, leaving you with a difference of negative 52,500 as your goodwill. But negative goodwill, you might think we've done the wrong thing, but trust me, it's very much correct. Negative goodwill, if you really read on the notes into the standard, it says that negative goodwill is an income and it's added to retained earnings. That's the statement that the standard discloses. Yeah, so that's that about negative goodwill. You also do for the joint venture, same thing. The purchase consideration for the joint venture was how much? I think we were told 250,000. What is the percentage on their net assets? Then they had the net assets of what? 470. What did we add? We didn't add properly. It's supposed to be 470. Sorry for that. Here on the joint venture, 470. Yeah, so when you get the joint venture portion here as well. So remember, 250,000 was what was stated, but you're not the one who fully owns it. So you just get that same 1/5 as usual. Even here, that's what you do for purchase consideration. This should leave you with 50,000. So 50,000 becomes your purchase consideration. So, and then I charged this 94. Where is it coming from? Go back to their 470. We said we were supposed to be always charging a percentage at net assets at acquisition, just like we did for the subsidiary. Now, here you only have 1/5. So 1/5 of the 470. To know which net assets you're going to subtract here, because you're always supposed to say less net assets at acquisition. That's how it is when you're calculating goodwill. And you also get a negative 44,000, which is again another income. So negative goodwill is an income added to group retained earnings. When you're done with this working, even go to NCI. NCI is not so difficult. The NCI calculation will have they told us that use proportional basis. So it's same thing. What's the figure for NCI? Non-controlling interest is 25%. So go and say 25% of the net assets at acquisition. Same story. When they say proportional basis, just go and always get at acquisition. Net assets at acquisition. That gives you 67.5. Then we are supposed to have the share of PAP right here, actually, as well. The post-acquisition profits that we found from the subsidiary, because here we're working out the non-controlling interest from the control in the subsidiary, which was 25%. That portion which you don't control, so to even call non-controlling interest. Then you put in it's supposed to be 2.5. Why? We had the 10,000. Remember, 10,000 was the PAP, but you're getting what you do not control, 25%. That's what goes here. Non-controlling interest has 2.5. Therefore, you have NCI of 65,000 there. No need of calculating NCI for the associate and joint venture. That's it. So that's the working. You can go to group retained earnings. Will come to it soon because it will have a lot of portions or additions to it. I want us to do the investment in associates calculation. Investment in associates, according to the equity method, it states that we should have the costs. How much did you acquire this associate at? 75,000, less any unrealized profits we had. Remember that calculation of 3,150, that one we found. We have to less that out. And also, do we have any post-acquisition profits? We don't. We found that there was nothing given to us about share capital, retainings for the associates. So therefore, 0. If it was there, we're supposed to what? Less. Then basically, these two, when you put them together, oh, by the way, we're subtracting this. When you put them together, these two, between gives you 71,850. This is like supposed to be your investment in associates remaining total, but they said there's impairment. This is why you now charge impairment on the subtracted figure. Don't ever charge it on the initial 75. No, don't charge it on the initial cost. Charge it on the less of all these. So you charge 20%, so you can know how much impairment will be here. This will be 14,370. That's your impairment loss. Therefore, investment in associate gives you that. What do you take investment in associate? It's part of non-current assets. And that's it. Joint venture, you can also do this for joint venture, but they said use benchmark method. When you're using benchmark method, there's no need to do this. But they say use equity method. Even joint venture, you should calculate the investment in joint venture. Same principles. Because they just said equity, and equity method requires you to do what we've just done. Yeah. So we now go to the group retained earnings. What is this made up of? They're supposed to be the parents' retained earnings. That's what usually starts here. Parents retained earnings, there were 300. If you check when you review this, rewind this video, you find there's a 300,000. Then you're supposed to now bring in the PAP. It's not even PAP actually. It's negative. It came out negative. It's supposed to be post-acquisition loss. So it's supposed to be a post-acquisition loss because it was negative. And remember, it was 10,000. So as you're sharing it amongst the NCI got 25%, meaning for the group, within then you're supposed to get 75 because now that's what you control here, which you want to account for, which is 75. That's what you put here, post-acquisition loss. Next, we have another thing that you should list from here. This is as well, unrealized profit. That one we've been talking about from the sale in adjustment 1. There was an unrealized profit of 5,000 from that sale. All these are subtracted, by the way. If it was a profit like post-acquisition profit, it would have been adding. Now it's a loss. It was a loss, negative 10,000 from the subsidiary. Yeah. The next one here is unrealized profit, which is 5,000. The other one is impairment. So impairment, we haven't dealt with it here. Impairment. There's this impairment from the joint venture of 40,000. They were talking about it in one of the adjustments. So you also have to account for it here. Now they said it was a total of 40,000, but you don't own everything in this joint venture. You just have 1 out of 5. So what's 1 over 5 of 40? That's going to be, that's why I've put JV. So that you know it's coming from the joint venture. It's going to be 8,000. That's how much you put here. There's also another impairment from where? From the associate. All these there, you put everything here. Even if the subsidiary had impairment, also put it here. So that one, remember we found something like this, 14,370. If you recall, just recently or from doing it in the previous working. Then that's all. Another thing is the extra depreciation. I talked about it earlier on in the video when we were just handling the adjustments to understand them. It's 1,000. How we accounted, just rewind the video to remember we accounted for all this. We're adding it. Finally, yeah, the goodwills. That's all. So goodwill, we said if it's negative, it's supposed to be an income. So 52.5 came from the subsidiary and 44,000 came from the joint venture. So joint venture and subsidiary, like that, they are added. Total of group retained earnings 359 for 80. You should get something like that. Then that's it. I almost forgot one thing. Sorry. There is supposed to be also unrealized profit. I don't know how I missed that one. Unrealized profit from associates. The associate also had an unrealized profit of 3,150. Remember, unrealized profit, still more, you're supposed to subtract it. It's in intra-group. Yeah, so all those things, just recall. Unrealized profit for subsidiary, associates, if they're all there, put them in the group retained earnings as well. Yeah, then that's it. You get the 359 for it. Those are the workings. I just want to show you now the solution, and you'll be able to remember with everything talked about once you see the solution. And then, yeah. So that is the working. Basically, those are the solutions in short of this question we've been solving throughout. So there's this calculation you've noticed on the top. There was what have we put? 1130. 1130 is just coming from addition of the subsidiaries assets by plus the parents assets, and then the 8 is just the 8 supposed to be 8,000. As I said, I'm removing the last zeros. The 8,000 came from that 1 over 5 again. When you're accounting for anything now, when you're consolidating here, anything from the joint venture, you'll be using the fraction of 1 over 5. Everything 1 over 5, 1 over 5. Anything that's seated in the joint venture, just get 1 over 5. And that's what I was doing. That's where the 8 came from. But remember, it's equally being treated here. Yeah. Oh, sorry. The 8. Sorry, I beg your pardon. The 8 is impairment of the PPE. Sorry, I beg your pardon. The 8 is impairment of the PPE, which is supposed to subtract. They say that the property has been impaired in Weston's group. So, yeah, that's where the 8 is actually coming from. The 9 that you're seeing under the property, plant, and equipment is, remember, there was a profit of 10,000, right? Yeah, all that is supposed to be shown also in the asset you've just sold. And the 1,000, remember, we just calculated the extra dip. You're just supposed to net the 2. That's what the standard requires, which is 10 minus 1, 9. That's where it's coming from. And basically, that's what is being done here. Another thing we can just talk about is if you look at inventory, I talked about unrealized profits. That one which we sold goods initially to James Smithson sold to James, and we had an unrealized profit of 5,000. You should less it from inventory. Just remember that also. Trade receivable, that transaction of someone was recognizing a 20 and a 25. This is what I was trying to say that time. Remember, James on him, in the books, him was saying he has a 25 receivable, expecting 25, and that's why you're seeing a minus 25 there. If you really look closely on trade receivable, this is a minus 25. Let me try to zoom in. Yeah, you see a minus 25. That's what I'm talking about. You just remove it because that's what he was thinking. Then even when you go to the payables, this person, Smithson, also thinking that they were a payable of 20, so also get rid of that to 20. When you go to the payable, you see a 20 there, minus 20. But how do you account for the 5? It also has to be treated. It's the cash in transit, and that's why we've added it to cash and cash equivalents. Then you're done. That's how you handle this. Basically, that's what was going on. Then, yeah, these were the major workings, and then it balanced.